alert. The Pi network has crashed significantly this November. We're analyzing why it's falling and the outlook moving forward.
So the crypto market is getting absolutely hammered this week. We're talking over $1 trillion just gone. But in the middle of all this chaos, one coin, Pi network, seems to be taking an even bigger hit. The big question is, why? And what could happen next? Let's break it all down, using the very latest data we have from November 7th, 2025.
Here's what we're going to do. First, we'll look at the hard numbers, see just how deep this sea of red really is. Then, we're going to zoom out and understand the huge economic forces that are dragging everything down. After that, we'll zoom right back in on Pi network itself to see why it's especially vulnerable right now. We'll wrap it all up with 3 possible scenarios for the future and some practical strategies you might want to consider.
All right, let's dive right in. First things first, let's get a clear picture of the damage. Just how bad is it out there for crypto holders? For anyone holding Pi network, this past week has been, well, brutal. A drop of over 13%. That's a really significant move that puts it on the back foot, even for a market that's already struggling. But as you're about to see, this is definitely not just a Pi problem.
And wow, this chart, it really puts the sheer scale of this into perspective. The entire crypto market has lost a full $1 trillion in value since the start of October. Think about that. We've gone from 4.4 trillion down to 3.4 trillion. That has basically wiped out most of the gains from this year. So the key takeaway here is that a massive tide is going out and it's pulling all the boats down with it.
And that brings us to the big question, right? What is this tide? Let's zoom out and look at the 5 massive economic factors that are putting the squeeze on the entire market. In crypto, it's never just one thing, is it? It's always a combination of fears, policies, and market mechanics all hitting at the same time. So what are they this time? Okay, here are the 5 main culprits. First, the U.S. Federal Reserve is sounding hawkish. In simple terms, that means they're not likely to cut interest rates, which makes risky things like crypto a little less attractive to hold. Second, there's a huge sell-off in tech and AI stocks, and that fear is bleeding right into crypto. Third, the market is still feeling the aftershocks from a big flash crash back on October 10th. Fourth, the big institutions, Wall Street, they're pulling money out of Bitcoin ETFs. And finally, all of this is causing a leverage cascade, which is just a fancy way of saying forced selling is triggering even more selling, like a row of dominoes. Now, this quote here really hits the nail on the head. It shows just how tightly linked the tech and crypto worlds are. What Jeff Mighty is saying is that these two markets basically share the same pool of investors. So when confidence in tech starts to wobble, money just flees from everything that feels high risk, and that includes Bitcoin and especially the smaller altcoins.
And here's what that leverage cascade looks like in real dollars. Almost $1.8 billion worth of crypto positions were forcibly sold in just 1 week. That happens when traders who bet with borrowed money can't cover their losses. It creates this massive, relentless selling pressure that just feeds the downward spiral.
Okay, so we get it. The whole market is in a tough spot. But that doesn't fully explain why Pi network is down over 13% when other coins are down less. So now, let's zoom in on the specific things that are making Pi extra vulnerable. This table tells a really clear story. You've got Bitcoin, the market's benchmark, down about 6.7%. Ethereum is down a bit more, around 9%. But then you look at Pi network, and it's suffering a much, much steeper drop. The main reason? Very low liquidity. In plain English, that just means there aren't as many buyers and sellers active at any given time. So it takes a much smaller amount of selling to really push its price down hard.
And here's a huge factor that's adding to that selling pressure, the upcoming token unlock. This month, a massive wave of 173 million new Pi tokens are about to be released onto the market.
At today's prices, that's almost $40 million worth of new supply. Just imagine a flood of new tokens suddenly becoming available to sell. It can easily overwhelm the number of people looking to buy, which naturally pushes the price down. And when you look back, previous Pi unlocks have often been followed by these kinds of price declines.
And to make things even trickier, there's the problem of where you can and can't trade Pi. It's not on the giants like Binance, Coinbase, or Kraken. Without access to their huge user bases, Pi has a much smaller pool of potential buyers and way lower trading volume. That makes it much more susceptible to big price swings from a relatively small amount of selling.
So, we've pretty much diagnosed the problem. Now, what's the prognosis? Based on all this data, let's explore 3 possible scenarios for Pi over the next couple of months.
All right, according to the analysis, the most likely scenario at a 55% probability is what's called a bearish continuation. Basically, that means the price could keep falling. Next up, there's a 35% chance of consolidation, which is where the price just kind of bounces around sideways in a narrow range, and the least likely outcome, with only a 10% chance, is a bullish reversal. For that to happen, we'd need a major turnaround in the whole market or some kind of massive, game-changing news just for Pi.
Okay, so given those odds, the big question on everyone's mind is, what do you actually do? Let's break down some practical strategies, both for the short-term traders and the long-term holders. For the active traders out there, the advice is simple. Be careful. The key price level to watch on the downside is around 21 cents. And with this kind of volatility, using leverage to bet on the price going up is extremely risky right now. A potentially safer bullish play would be to wait for a clear, strong breakout above that 26-cent resistance level on high volume.
Now, if you're a long-term believer, a hodler of Pi, your playbook looks a little different. This downturn could actually be seen as an opportunity to accumulate more at lower prices, maybe through something called dollar-cost averaging. That just means you invest a fixed amount of money at regular intervals, no matter what the price is. But risk management is still absolutely crucial. It might be smart to consider selling a portion to lock in profits if the price does recover to key targets like 30 or 35 cents. So, to wrap this all up, here are the key dates to circle on your calendar. The Fed meetings in November and December are going to set the mood for the entire market. Right in the middle of that, you have the massive Pi token unlock, which could add more selling pressure. But looking ahead, the planned launch of the PiDex in December could be a really positive catalyst for the project.
You know, at the end of the day, the market is driven by these huge impersonal forces that are out of our control. But how you react to them, that's entirely up to you. And that really brings us to our final question for you to think about. In a market this wild, do you see a price crash as a threat to your portfolio or as an opportunity for your strategy?